Every investor has felt it. You open your portfolio and everything is red. Your stomach drops, and the first thought is, should I just sell before it gets worse? But the truth most beginners learn the hard way is this: selling after a drop often turns a temporary loss into a permanent one. When a stock drops, the loss is only on paper until you sell. The moment you hit sell, you lock it in. Markets move in cycles. Pullbacks, corrections, and crashes are normal. But selling means you're no longer in position if and when it recovers. A big mistake investors make is assuming a drop means it will keep falling. In reality, many of the strongest recovery days happen right after the worst ones. If you're not invested during those rebounds, you miss the compounding that actually builds wealth over time. Most selling isn't logical, it's emotional. Fear kicks in, and people start thinking, what if it goes to zero? But successful investing isn't about avoiding fear, it's about controlling it. The investors who win long term are the ones who don't let emotions make decisions. Instead of panic selling, experienced investors usually hold average down when the fundamentals are strong or rebalance with intention. They understand a simple truth: volatility is the price you pay for long-term growth. So when your portfolio turns red, remember this: drops aren't a signal to panic, they're a test of patience. The real mistake isn't holding through volatility, it's getting shaken out right before the recovery.